simple demonstration I want to show you of 3 different income areas that most of us build our assets and receive our income in. And it's a snapshot to be able to understand the tax system. In the first instance, most of us work and we receive an income in our personal names. This here is the marginal tax rate, and it varies from 0 to 47 cents in the dollar, not including the Medicare levies that we pay. The thing to understand is when we're building income in this area here, it could be then that we're going to buy assets in this area, like houses, cash, shares, and they will still get taxed at that same tax rate. Then you fall into a company space, which might be the case if you're self-employed, and then you've got a flat tax rate, which will possibly soon change with the new budget, but currently it's 30 cents in the dollar. And then we come into superannuation, which a lot of the times people think of super actually as an investment, whereas superannuation is a retirement tax system. And within that tax system, we've got a current rate of 15%, so that means any money that we put into super from our employees or contributions that we make can get taxed at 15%. Any income that we earn in this area too will be taxed at 15% whilst we're in accumulation phase. There's other ways to be able to get money into here that you might not be taxed on, but for now we'll just talk about standard contributions going into it. If you're in pension phase, or when you go to pension phase at the moment, you're at a 0% tax rate. Why I like to look at the tax system like this is it helps us understand, by having a look at just the numbers, how do we begin with advice, with working with the income that you earn, to be able to get the most out of that income. And simply here, I think if you have a look, there's probably tax systems that you can see that are more attractive than others. Now you might ask, where does a trust fall in, like a family trust? Well, usually what would happen in that instance, it might come through from a business, but in one way or another, your income is going to flow back to the individuals who are beneficiaries, or it's going to flow back to a company there. So it'll still be taxed, just depends what system that it actually gets taxed into. The next thing that you look at is also, like if you're at a stage where you go to retirement, you might have assets built up in this system over here, being superannuation. They will then convert to a 0% tax rate. However, any assets that we continue to hold over here are still going to get taxed at this rate here. So it's very important when we work with you on planning which system we use and why we use it. The other thing is when we go to sell our assets, there's capital gains tax that will be applicable for certain assets when we sell them. So if it's held marginally here, it'll be taxed with a 50% concession. So we'll get a discount on whatever gain that we've made, which means overall you're looking at paying half the marginal tax rate depending how much profit you've made or gain you've made from it. When we come over to the super tax system, the concession is 33%, the discount that you get. However, the tax rate's lower, so it means that you end up paying a lower tax rate overall. If your assets then go into pension phase, they'll then be taxed at a 0% tax system. Company system, there's a number of different benefits where we have concessions on capital gains tax, which is more complicated than we need to discuss today. I hope that helps you. I hope it gives you a little bit more understanding of how we work with you and how we want to get these numbers to work as hard as possible for you.